What are the historical market challenges of the carbon markets, or the roadblocks to large-scale trading? And what role can cutting-edge technologies such as AI and ML play in facilitating the extraction of meaningful insights for the carbon markets? Hi, my name is Paul, and I just want to thank you today for joining our podcast. Now, carbon credits have emerged as a powerful tool in the fight against climate change. Among others, it encourages investment in cleaner tech and sustainable practices. As the world aims for net zero emissions, the carbon market drives crucial transformation across industries. However, we need US $25 trillion of notional issuance in carbon between now and 2050 to achieve net zero. This is a huge figure, yet failure is not an option to avoid global-scale environmental catastrophe. To answer these questions and more, we speak once again with Andrew Gilmour, the CEO of NetZero capital monetization pioneer Laconic. We are also joined today by Srijay Ghosh, founding member of digital transformation services company Temus, their technology partner. Thank you for joining us today, Andrew and Srijay. If I may jump straight into the multi-trillion-dollar question, do you think we will succeed in achieving net zero by 2050?
Thanks, Paul. I think you ask indeed a trillion-dollar question. It's not about if, but how. And for us to get there, it will require the collective efforts of all stakeholders that we see around us, the government, private sector, businesses, communities, and individuals, ourselves. And if we bucket the solution into three areas, what I call three input metrics, one is energy systems and how we transition to renewables. Two is infrastructure and enablers such as funding, financing. And third is lifestyle shifts towards an environmentally conscious consumer. But what are the output metrics we are trying to solve for to get to this target? They're effectively two. One is, can we create a circular economy that regenerates? And can we drive economic growth without carbon? There are some silver linings, if I may, because if you look at the decarbonization roadmap over the last 2 decades, if you look at clean energy generation, solar capacity has gone up 500x over the last 2 decades. Again, driven by private sector investment, public sector policy, and investment. Second, upon generation, if you look at clean energy storage, lithium-ion prices have gone down 90% in the last 10 years. Again, through scale, we are driving better economics. And what that has led to is that electric vehicles are almost close to reaching cost parity to ICEs over the next 1 or 2 years. The same thing is happening on grid resilience, hopefully, where we are able to build grid-scale energy storage systems, and then that's supporting green-built environments in the future. But these are some very good silver lining. The third thing that I want to say is the government has a very important role to play, both in mitigation and adaptation. In mitigation, we are going to talk a little bit more about carbon markets and trading. Enabling that ecosystem is extremely important. Last but not the least, the funding of technology that drives the innovation in the energy systems. Now, if we think for a second about the carbon market and trading, it's not just government as an individual, but governments collectively cooperating to enable these markets. I think we hope that that day is soon, that we will have a global carbon market, just like we have capital markets for equities and fixed income. The second interesting driver to this would be what I call mitigation funding, where developed countries commit funding to mitigation of less developed countries, and how that plays out will also be critical to driving parity and equity in which the whole world moves towards that net zero target. In terms of adaptation, there are again some green shoots on various communities and municipalities. There's an example in Toronto where they instituted a heat index to help the citizens cope with extreme climate. and prepare in advance, have early warning systems around it. The last thing I want to mention is the financial services sector. Again, the source of money that drives change. The ability of the financial services sector to freely offer products and services that mitigate the risks of a carbon-constrained economy is going to be absolutely critical. Like you said, pioneers like Laconic are really building the, so to speak, building blocks for this sector to operate and scale efficiently.
Sounds like there's a lot of moving parts and a lot more that we need to do. Andrew, what are your thoughts on this?
It's definitely a lot of moving parts. And echoing what Srijay said, I think from a macro point of view and a capital markets point of view, a carbon credit really is a risk transfer instrument, right? And so when we talk about making markets in carbon, what we really talk about is exchanging environmental exposure or risk between counterparties, right? One or more. And ultimately, this facilitates a flow of capital from the global north to the global south. The global south is long carbon and short cash. And the global north is long cash and short carbon. And the facilitation of this macro flow over the time period between today and 2050 is really the key to us achieving net zero during 2050. And ultimately, because we're exchanging information, this is a technological challenge. And that's not to minimize the political and the regulatory challenges that Srijay mentioned, because those are definitely factors that come into play. But I think it's easy to get worried when you think about the curve of technological change. Right? They tend to be very hockey stick or shaped. They start out slowly and they build momentum until a certain critical mass is reached. And progress towards net zero has a similar growth trajectory. It's not linear. And so it's easy to forget that, I think, at times, and to become unduly pessimistic. But certainly the technology is in place, the regulatory wherewithal is in place, and we're seeing a consolidation around a common viewpoint that is going to enable us collectively as a species to achieve net zero 2050.
Well, it's great to hear that, this growth should accelerate over time. But I'm just curious as well, right? I mean, historically, what are some barriers when it comes to carbon trading? I mean, Srijay, would you be able to have a take on this?
Yeah, sure, Paul. I think I want to reiterate there are some macro barriers clearly, on the political side. There's a lot of chatter around trading, undermining national sovereignty. Then does trading fundamentally reduce emissions? But I think we all have to grow beyond looking at this on a localized manner, because I think what happens in one part of the world impacts some other part of the world. And I think it is a global problem, and we need to really think globally as we think about solutions. And I hope policy is driven that ways. And a part of policy is also driving, as I said, driving consensus. Various, what you see today is there are different levels of commitment in different parts of the world. There's differences in policy and policy priorities. All that does is creates market volatility and price uncertainty, and that is never good for trading. So we do need to fix that. As actually, in the context of Singapore, through the Carbon Pricing Act and the transparency on carbon tax, it is a very good example on how transparency can eliminate uncertainties in a market. The second, at a micro operating level, is the trust and transparency on data that underlies trading. Data on accuracy of emissions reporting, data on legitimacy of offsets, then monitoring, active reporting. If you think of the equity markets, there's a quarterly report on any company that issues a security that is traded. So think of it very similarly, that if there is a security that is traded, is there active monitoring to check progress of the underlying asset of that security? So there is a lot of work that needs to be done there to bring that barrier down. And to bring this to life, if you think about carbon trading, there are three actors. There's the developers who who own and develop these assets. There's the consumers who are buying securities backed by these assets. And then there's exchanges who are meant to facilitate the trade between the developers and the consumers. Now, what the consumer is looking for is doing due diligence or having trusted due diligence on the asset underlying the security they're buying. And that data pedigree, that trust and transparency of that asset is very important. What the exchanges are looking for to facilitate a trade is to make sure that the asset underlying is unique, identifiable, and can be monitored on a periodic basis. And then, as consumers are looking at an exchange to buy this asset, they would go to an exchange because they think the price discovery is fair and the risk management around claim hearing, settlement, in future selling that asset is frictionless. And now if you just abstract and think about the carbon markets today, it comes back to lack of trust, transparency, integrity, unique identification of the data of the asset that is kind of limiting the scaling of trading. And I would say that is exactly the problem that Laconic is trying to solve and enable. And Temus, from a technology standpoint, is very excited to solve together with Laconic.
Thank you, Srijay. And maybe over to you, Andrew. I mean, how does Laconic's technology, built right here in Singapore, in conjunction with Temus, work to solve some of these challenges that Srijay just shared?
Yeah, there are a couple of critical technological aspects or sub-solutions that collectively form a stack, which facilitates orderly market function and scalability. And I think critically, it all starts with the definition of a carbon credit. In the past, carbon was traded at a project level. Right? We were technologically limited and unable to tie a ton of CO2e, which is the core element of a carbon credit by the UNIFCCC's definition, to a particular place on the land. And so we had to kind of group it into a bigger basket, and we used this project modality that came out of the 1980s and the 1990s, when the concept of a carbon credit as really a form of social capital transference was created by multilateral organizations. And now we're at an inflection point in the marketplace where we need scale that only the global capital markets can provide. And so the concept of the carbon credit itself has to be transformed. And this is actually easier done than said, I might say, because a carbon credit is really just a packet of information. And so we can change the composition of that packet of information in order to fit it into existing regulatory constructs and then facilitate the scaling of the markets. So I'll give you an example of that. Would be serialization, right? Before the platform that Laconic and Temus have collectively built, STAR, there was no unique identifier for individual carbon credits in the global marketplace. And if you could imagine buying a stock or buying a bond without a CUSIP or an ISIN, it's not a perfect analogy, but it's close enough for this purpose, is that you need an identifier. You have to know what you're buying in order to be able to transact in it. And so without a global identifier, we have these very small transactions that really settle in what we call dark pools. It's kind of like two lawyers across a table from one another in a conference room, and documents get signed. There's no price discovery. Nobody really knows the transaction occurred. But these are the kind of transactions that are happening now between the big corporate buyers, the Metas, the Googles, the Microsofts of the world, originators. With serialization, you can drive traffic to an exchange, right, to that end user buyer, without requiring massive scale in order to make the economics of the transaction work. So, one of the key things we've done is create that serialization paradigm. The second core element, technological element that works to underpin this is tying that carbon credit that we now can identify to a particular spot on the land. Carbon is a characteristic of the land. It's never removed from the land, so long as the credit exists. And so we need to be able to make sure that we're not double counting carbon. We need to make sure for carbon activities inside of countries that are signatories of the Paris Agreement that we're accounting for and netting that activity against what's called the NDC, the nationally determined contribution, which is kind of the baseline that every national signatory of the Paris Agreement has committed to in terms of their overall emissions footprint. And this requires a robust technology stack, remote sensing, right? And really being able to tie this to the ground. And so we've been able to do that and diffuse kind of geospatial information with traditional financial data. And then third and finally, you get environmental data pedigree. By that I mean, we need to be able to score this information that is used to create a carbon credit. And we need to be able to do so in a way that's analogous to like a FICO score, like a credit score. We have to do so algorithmically. We have to eliminate humans and emotional judgment from the loop and biases from that loop. And we need to do so to create a wholly digital chain of custody. So in a regulated financial market, anytime a human being keys in data, the regulators have a conniption, right? I mean, it's the quickest way to get, a 5x risk weighting from your risk desk, is because at best, human beings make mistakes. They fat finger data. They make a data entry error. At worst, they fraudulently misrepresent the data. And we see this today in the small scale transactions we have with unscrupulous project developers selling the same credit to 3 different buyers at the same time to triple their return. All of that goes away with digital chain of custody, transparency, immutable databases using blockchain technology or other types of immutable and publicly accessible data stores. And then now we have a common language. When we have a common language, we can compare carbon from Africa to carbon from Southeast Asia to carbon from Canada, because ultimately at their core, they're a 1 ton of CO2e. But in the past, that similarity was overshadowed by differences on the surface, right? People couldn't look beneath the skin. They were effectively judging the book by its cover and saying, oh, this is a Corsia credit. This is a Vera credit. This is a Paris compliant credit. Those are like toppings on top of the ice cream, right? And then carbon is the vanilla ice cream. And with technology, we can track all of those differentials, and we can allow baskets of carbon to be created. And that drives scale in the marketplace. You said at the beginning, $2.5 trillion of annual flow. It was $3 billion of flow in the voluntary markets globally last year. It's effectively 0% compared to where we need to be. And so we need to enable scale in these institutional scale transactions, 1 million tons, 2 million tons at a block at $25 to $50. These are large scale transactions. The good news is we have markets and we have technologies that are battle hardened. We know how to settle. We know how to clear. We know how to arrange for custody of these financial instruments. And it happens millions of times a day with billions of dollars notional value. And so we bring carbon into that ecosystem with technology. We'll achieve the scale we need, and we'll get to net zero.
Thank you so much, Andrew, for answering my next question as well. How do you bring it to scale, right? And I think you alluded just now that, with technology, you can actually go down to, you can sell much smaller blocks of carbon, bring it to the smaller organizations beyond the Googles and the Metas of the world, right? And obviously with technology, you can scale it as well.
Right. So we can drive demand, and on the demand side, by enabling smaller buyers to have price transparency and access to markets that only large-scale institutions currently have, we increase demand. On the supply side, that technology actually works in the reverse, where we take small plots of carbon and we aggregate them together to create blocks of carbon that are large enough to drive institutional scale. Right? In the capital markets, the invisible hand of capitalism is always at work. And when we stand up a carbon desk for regulative, a GSIB bank, or a global systemically important bank, wants to stand up a carbon desk, the rare regulator, whether it's MAS here in Singapore or the SEC in the United States, requires them to allocate regulatory capital, right? Go through compliance, do risk analysis and the like. And so the fact is that unless that organization can do $400 to $500 million of top line revenue in that business line on an annual basis, there's no money in that business activity for them. And that's why the global banks currently are on the sidelines. They're not trading voluntary and carbon right now. And where carbon trading is happening, it's being handled by commodities trading houses who are treating carbon like a commodity, even though it isn't. Commodities can be delivered. You can't deliver the carbon, right, to your doorstep. And so these commodity trading houses are treating it like a commodity. They're effectively arbitraging a regulatory loophole. And you have the major players, the major banks, the major trading desks, the major exchanges and the like on the sidelines. They're on the sidelines because they don't have access to high quality reference data. They don't have access to aggregated information flows and the like. And so part of bringing the marketplace into existence is really bringing the information to the right people at the right time. It's contextually appropriate, serve it to the right person, the right place at the right time, and then the marketplace will begin to function. Because all of the constituent elements already exist. They're already regulated. They already have expert people, groups of people, organizations that are active in those marketplaces. Digital settlement, custody, clearance, trading, compliance, risk. All of these functionalities exist in the capital markets today. And so if we can if we create with technology a data structure for carbon that allows them to treat carbon like something they're already familiar with, right? A derivative in this case, then they can trade it. And most importantly, the regulator can regulate it already. And that drives trust into the marketplace and it brings capital off the sideline and drives that transformation forward.
Thanks for the insights, Andrew. Srijay, what are your thoughts on this?
I had a spark in my mind when I heard the word invisible hand. It's such a good way of looking at market economics. And I'm going to quote Adam Smith here now that you brought it up. This famous quote, right, is not for the benevolence of the butcher, the brewer, or the baker, but for the regard to their own interest, right?
Correct.
So it comes down to that, right? An efficient market is where millions of decisions are made by shoppers, traders, bankers, consumers, and which effectively feeds back to the most efficient growth and consumption of the resources. And that's really, the essence of investment. And that is exactly, I think, Andrew, what you're talking about, right? How can, there are pieces of innovation that can happen in different parts, but ultimately everybody needs to come together to make carbon trading and scale work. There are innovations happening on the supply side, right? There's a lot of scaling on renewable energy, carbon capture, a lot of innovation, a lot of capital going in there. But ultimately, it is that invisible hand and the ability to catalyze the supply to reach the hands of the right buyers in a safe, secure manner is what will ultimately drive scaling institutional block trading in the context of carbon markets and all the other things that we said, right? The confidence, the legitimacy, the integrity of the data, the safeguards of a regulated and a compliant environment to facilitate. All those are good hygiene factors that the governments have a key role to play, but ultimately only the invisible hand will solve this problem.
Well, Srijay, I like how you put it. I mean, when you simplify everything down to its bare minimum, really it's about connecting the suppliers with the buyer, right? And obviously technology has a role to play to make sure that it's scalable and to, make it efficient. My question, Srijay, what role does AI play in facilitating this journey, so to speak?
It comes down to the cost of monitoring, verifying data with accuracy, with precision, doing it real time. I think what AI can do is two. One is bring the cost of monitoring down. Two is reduce the complexity of the various sources from which this data comes. And a bit more, if I double click on these two, on a more functional level, um, natural language and machine learning can really help in data integration, cleaning, automation of these diverse sources from which data come from. Sometimes, there are if you're lucky, well documented in PDFs. Sometimes data is also in handwritten paper. You're talking about, assets sitting in Africa and Brazil and all around the world where there may not be well documented information. Then you're relying on geospatial information, and you're kind of bringing all this together to provide that integrity and trust. And it is impossible to scale this at a global level without using AI, automation, and machine learning. The second thing is, classification and tagging of this data based on the data structures, the content, the metadata, and what does it help? Andrew showed me the other day in the Laconic platform. One is the data and the data pedigree, but two is the searchability of that data, and that is where generative AI and the innovation there has a huge role to play, right? I draw the parallels with, if you think about the equity markets, if I want to invest in a security of a company, an asset, I have a lot of research to analyze before I make that decision. In this universe, making that discovery and diligence process efficient, easy, by improving searchability, by leveraging on technologies like generative AI, will truly accelerate the path towards scaling the trading in carbon. I think the last thing that I would say is, in Temus, we strongly believe that AI, just as any other technology, is an enabler. It's a means to an end. Ultimately, the human centricity of how this data, how user engages with this data is extremely important. So the visualization, the way you can trace the pedigree of the data and trust it, how you see the linkages across the chain is going to be very, very important. So I think as much as AI can accelerate, but how you help people visualize the integrity will ultimately build trust that you need.
Thank you so much, Srijay. It sounds like AI has multiple roles and multiple layers where it can make a difference, right, to accelerate our journey. Andrew, what are your thoughts?
Yeah, I agree with everything Srijay has said. Beginning with the end in mind, I think is critical. And riffing on Srijay, your comment that AI and ML is an enabler, I think that's a critical distinction that we can't lose sight of. We don't want in our zeal to latch onto the latest, greatest tech, create a solution that's in search of a problem. And in this case, AI has a fundamental role to play in enabling the user or the end user of the information or the extracted insight from the data store to be able to understand clearly what that insight is, right? To extract the signal from the noise, as it were. I'll give you an example of that. When creating MRV models, modern measurement, reporting, and verification models, the bulk of those models, state-of-the-art providers are using machine learning models, right? Land use, land cover classification models. And those models can be classified by certain mathematical data points, metadata points related to the And understanding how to interpret those enables you to understand where to use that information in the context of your diligence process and a decision process. And that kind of gets into the data scoring we were talking about a few minutes ago. We can also use LLMs and generative AI to allow the user to interact with this data store that has not only a tremendous volume of data, but also a tremendous diversity of data formats, data types, especially geospatial information. We have satellite data feeds with, sensors that see in 256 bands of the electromagnetic spectrum. And how do you process that information and how do you use it and combine it with price information or kind of more traditionally structured financial information? Being able to ask a question in your native language to the AI and have the AI handle that fusion through the platform together and give you an answer out. Well, that's really kind of a fundamental premise and goal of Laconic and where the company takes its name from. We want to speak simply and clearly and directly. The clearer and more direct we can be as a technology provider, the more market flow we drive. In terms of that diligence process, when we started building Sidar with Temus, we went and we did some informational interviews with some of the largest trading houses in carbon. And we were horrified. They would tell us, an analyst would do a week's worth of diligence on one trade, a single trade. Could you imagine doing a week's worth of diligence, a man week of diligence on a single equity trade? And so there was ample scope to bring technology to bear to solve this real world problem by making the data more accessible, more manipulable, but also more trustworthy at the same time. And that really is the holy grail, this plasticity of knowledge and information, but it's also one that's wholly trusted at the same time. That's what we've been able to build with Srijay and his team here at Temus.
Thank you so much, Andrew. I mean, I like what you say about using technology to bring down the barriers, right? So to simplify things, to make it more direct, and to basically increase market flow. I think we really need that when it comes to protecting the future of our future generations. So on to my last question. And what are some trends or changes that you anticipate when it comes to technology? And how can technology manage to mitigate or resolve them?
Yeah, I think the biggest trends here are cost of compute continues to come down. Cost of storage and transport continues to come down. And availability of raw data, of input information is becoming nearly ubiquitous to the point where the chief challenge is actually transforming that raw data, selectively analyzing subsets or slices of that data to extract meaningful information. We're almost drowning in raw information. And so the answer from my point of view is not more volume. The answer is better insights and more clarity. And we need to develop technology platforms that facilitate that end goal. And the driving cost of compute down is very, very helpful. The democratization of that input data is very helpful. And the maturity of the carbon analytics marketplace is a very helpful technological improvement. It's really a socio-technological improvement, but I'd like to focus on that because as the marketplace matures, the cream does rise to the top. And so there were a lot of black box technology applications or specialty providers and the like that the increasing transparency in metadata and in globally available data sets are driving them out of the marketplace because they really weren't adding value commensurate with the price that they were charging. And those efficiencies, while not good for certain market participants, overall, the rising tide does lift all boats. And we need to get there as a market and as a global community that's active in the trading of carbon as a risk mitigation instrument. So I personally am very excited for the potentiality to continue to leverage technological improvement to drive that socio-political goal.
Yeah, truly, we need to get there together, because the opposite of that is we will not get there at all, and that is unbearable. Right? We can't fathom this such a future. Srijay.
Yeah. Andrew, you mentioned one point on everybody coming together, and I'll just pick a point that, my reflections coming out of the COP28, that a lot of the NDCs, I think, needs to be revisited and the targets need to be strengthened. I hope in the coming year, we see a lot more clarity on these targets, and particularly not just about the NDCs, but also policies that help bridge what we see as an implementation gap. That aside, coming to your question on, trends in technology, I think we talked about AI, and we talked about AI in the context of data integrity and quality. But I want to also highlight that AI has a big role to play when it comes to driving energy efficiency, both on the mitigation side, on how, let's say, smart grids work, or how do you optimize energy consumption or increase renewable energy yields, but also on the adaptation side. I give the example of Toronto in the context of urban management. We hope to see AI accelerating that. The second thing is also about educating the citizen, the consumer, in scale. And there is no way you can reach 1, 2, 3 billion people without leveraging on AI and really educating them on best practices. The second thing, is around, this is more around the private sector. Think about reporting, it has gained a lot of traction. There's a lot of resource that has been allocated to reporting. But today, still, there's a lot of skew towards taking an audit lens to reporting, not a solution lens. And I think one trend that we'll see over the coming years, particularly as CEOs take a long-term view, is not just reporting for the sake of it, but to actually drive outcomes, rethinking their operations, rethinking their supply chains. And I hope there is resource allocation going there so that you're creating actually long-term sustainable business. And the third thing, which is my last point, which is just like resource allocation when it comes to reporting and running a business, capital allocation when it comes to deploying private and public capital. And I will close my remarks with something that Andrew mentions time and again, that to achieve net zero 2050, which was your first question, requires 25 trillion USD new issuance of carbon-linked instruments. We are the tip of the iceberg today. There is a lot that needs to be done, and everything is centered around data integrity and data interchange platforms. So technology has an absolutely critical role to play to accelerate that.
Thank you so much for your time, Andrew and Srijay. I really appreciate your sharing of your insights.
Thank you, Paul.
Thank you.
We've arrived at the end of our podcast.